And that does, because one of the things I wanted to bring up is you brought up you discussed with Darius that you thought that pretty much all US financial assets are overpriced. Now, presumably from what you said earlier, you don't mean bonds, but other financial assets. So obviously the stock market. And if you think the stock market at some point can go down significantly, that's an implication that it's overvalued, which of course virtually every metric you look at is screaming that the stock market is too high. But it doesn't go down, or if it goes down, it just goes down for a short period of time, then it comes roaring back. And one of the points you made is that one of the biggest drivers of liquidity in the United States is the stock market. So with the stock market having done what it's done over the last 6 weeks, are we back into a situation where there's excess liquidity? And is that a challenge for inflation? Is that going to avoid a recession? I mean, do you have outlooks on inflation or recession right now?
Sure. So I saw like a little pop-up, and it was like, what is trade equilibrium? And I'm gonna answer that question and answer your question. Okay. So trade equilibrium, unless I just imagined it, trade equilibrium, it would be the notion that over 40 years, the US would have a pretty strong probability that kind of like maybe 10 or 12 of those 40 years, the US would run a surplus, that China would run a deficit. But we got 40 years where it's no like deficit and surplus, right? So that is not trade equilibrium. Equilibrium is you push one way into like lots of surpluses, and then you get pulled the other way. That's equilibrium. It's a man of war, like two tries pulling on a rope. Yeah. Sometimes you're stronger, sometimes you're weaker. That's trade equilibrium. When it's just one team and they're strong, you're pulling the system over. So again, think of it as, I would say bullies, but it's economic bullies, but you are having a huge difference. Now, liquidity. Liquidity. Now, and now I've got like this guy, Jeff, I'm now talking to him, but anyway, Jeff, later, he's talking about free markets. Liquidity. Liquidity is a term which enrages me in its misuse. But you got it head on. And so my compliment to you.
Well, I was just quoting you, so.
Oh, well, that's where you got.
How can I be wrong?
Well, now my ego is out of control. So for me, then, liquidity is rising risk asset prices, and liquidity is destroyed when prices fall. So what I mean by that is you have a balance sheet, you have assets and liabilities, and so whenever we talk about US debt to GDP being very, very high, that's true. But the accounting implication of that is that our wealth is also very, very high. Because because it's an identity. Yeah.
So based on that thesis,
when stock prices are going up, you've got asset prices which are going up, but your debt doesn't go up.
Right.
Okay. And so that makes your lenders and those who are collateralized lenders to you, they start calling you saying, you've got more margin. I can extend you more credit. And so that is liquidity that you're generating. And of course, that works in the reverse. It's like an interactive broker's account, yeah? Risk asset prices go down, and you get a margin call, which means you got to sell something. That's
which we had 6 weeks ago. We had a global margin call for a few days.
But what I mean by that, so no one has a model, right? There are no models. There are no proprietary models. It is all BS. Liquidity is a BS thing, right? Prices going up, liquidity is good. Prices falling, liquidity bad. Okay. Now, the S&P from the beginning of 1980 to presently, now that's a hell of a long time, but the S&P has multiplied 60 times, 60. Oh, that's a lot. That's well done, Captain America. Bloody well done. But that really is a lot. And as we know, valuation metrics assessing the stock of valuation to the flow of GDP, we're at metrics which are extended. And I would say to you that 40 of those years have come from a system where the persistent trade surplus. So I've got $1 trillion flowing in. Okay. And if I don't sterilize it, that $1 trillion is going to bid up my renminbi. But instead, I take your trillion and I push it back at you and I buy $1 trillion. Okay. I've neutralized and I have prevented my private domestic consumer getting richer. But I've kept my ambition, which is the persistency of surplus. Now, I've just put $1 trillion of liquidity back into dollar assets. And I've probably bought the risk-free cash bill. Now, the risk-free cash bill, I'm going to go into the euro dollar system and use it as collateral, and I'm going to earn a rent on the American dollar. And that euro dollar system, which is a pawnbroker, is going to extend credit to private equity, to hedge funds, to everyone to buy assets. And so I say to you, no surprise that the S&P went up 60 times, because within that period, we created a paper printing machine. And it was not called the Federal Reserve. It was not called quantitative easing. It was called mercantilism and the avoidance of equilibrium.